For more on the outlook for energy prices for the rest of the year, we turn to Ed Morse, Citi Global Head of Commodities. Ed, great to speak with you. I am going to start with oil. Is there an OPEC put in the market here?
There has been an OPEC put in the market, and yes, there still is. And OPEC, surprised the world by announcing a cut after saying no more cuts, no more changes for the rest of the year. And it probably is in response to the weakness that we're seeing on the demand side. So yes, that's what they're looking for. $90 oil probably, and not something in the 60s.
So how do you balance that against the possibility of recession, as we are seeing increasing data showing signs of, at least in the U.S., economic slowdown?
We're seeing economic slowdown, so to speak, not only in the U.S. but elsewhere in the world. China's expected jump in demand is just not materializing. China's recovery has not been led by goods but by services. So we're now questioning whether the 700,000 or 800,000 barrel a day jump in Chinese demand that we had been forecasting is going to come through. And meanwhile, yes, U.S. demand is down year on year, and it looks like it's going to be even weaker than we saw. So we think the prospect for prices is going to be on the downside rather than on the upside.
We have to talk about the other energy market that's been seeing wild moves as of late, and that is natural gas. We had an unexpectedly warm winter season, not just in the U.S., but in Europe and other parts of the world, too. Prices basically around $2 right now. A year ago, we were at what, close to 10? Do we have farther to fall from here?
We don't have much farther to fall, but it could fall well below $2. We have too much drilling, too much supply, and not enough demand. The U.S. is being poised for phenomenal growth in the LNG export market, but those LNG export facilities are not going to be ready until sometime late, probably in 2025. And therefore, the producers are primed for a market that's yet to materialize. So we're looking at weak market prices for the next quarter or so, until maybe the drilling falls even further and we can get supply demand back into a proper balance in the U.S.
So what could happen with natural gas prices over the rest of the year, both in the U.S. and in other markets in Europe, most particularly? Could they go up dramatically?
Yes, they could. And we actually expect that European and Asian prices are likely to be, twice as much this time next year as they are now. That doesn't affect the U.S. market so much because we are kind of maxed out at how much we can export. We can't export more, so whatever we produce has to stay in. And that'll be the case until we get this phenomenal increased ramp up in our ability to export out of the United States. But meanwhile, not only are we not increasing our LNG capacity to provide Europe with more supply, but nor is anyone else in the world. So the global market is seeing supply curtailments. They're not seeing more LNG, and we expect demand to be growing across the planet over the course of the year. And with that, this artificially low price that we've seen in Europe is bound to get higher, doubling or even tripling potentially, depending on the weather.
As the head of commodities research, how closely you're tracking oil, which is back above, or is above, well above $2,000 an ounce right now? It's really having a moment.
Gold is having a moment, and yes, that moment is going to come and go, but mostly come rather than go. Gold responds to interest rates. Gold responds to the value of the U.S. dollar. We expect, after the next couple of increases in rates by the Fed, that they're going to be curtailing. And we also have a forecast of a much lower dollar. DXY, the average of index for the U.S. dollar, has been above 100. We think it'll be below 100 next year and the year after, and that speaks to gold going up above 2,000 on a more permanent basis, and even reaching 2,100 before 2024 might be over.
Oil is up about $14 a barrel in the last 10 days or so. Where do you see it topping out, and is that a sustainable top, or is the oil market likely to do what the oil market often does, and that is overreact and then fall back?
Well, so on that, where oil prices were in the 60s, that was an overreaction to what was happening in the U.S. financial sector and the global markets. And it went down more than the supply-demand balance warranted. And now we've jumped up above where the supply-demand balance warranted. And there are people saying, hey, around the corner is $100.
Ed, I need to cut you off right there. We've got some breaking news as